So where are we looking specifically with the banks? We're seeing our national bank target at around $38. That's pretty similar to most of the sell-side analysts, i.e. the stockbroking firms that we talk to out there, the big ones. We're carrying national bank at about 7.25% versus 6% weight in our concentrated fund, which is an aggressive, concentrated share portfolio of 35 stocks. And in our income fund, we're running it at 7.6% versus 6% market weight. And we believe the combination of what they're doing in the UK, their strong business banking franchise, will also help us in terms of getting some additional profitability. So I'm maintaining an overweight position to NAB. Reasonably controversial. Most people would have it as a hold. Some have it as a sell. But we believe that there are some significant catalysts in the bank, and Thorburn, as the new CEO, is probably going to bring a lot of concentrated energy to the book. So we're still in the watching phase with the new management team that he just signed up a few weeks ago, and we're looking forward to that. With ANZ, we were very overweight, and we cut our exposure back after a lot of that lower dollar fruition came through. So we had the dollar fall, we had a nice benefit from that. They had a really good earnings growth rate compared to their peers. It may slow down a bit from here. With ANZ, we've gone from roughly 2%, 3% overweight the market. We've cut that back to sort of market weight. CommBank, we hold it roughly market weight, give or take a few basis points. My view about the result yesterday is it was a very good result. Matt Conwin from the retail bank should be applauded. And I had a meeting with him a few weeks back. And we met with the credit card team and the IT team, and I think they're doing a great job. Certainly you'd call them the young guns of the banking industry. So retail was exceptional. So net interest margin, up around 226 basis points compared to the average of the bank at about 213 basis points net interest margin. Where I'm writing a piece for our clients that'll be released shortly. What I say in that is it's like waiting for Godot. We're waiting for business to improve in Australia. Everyone's got their market share pretty much worked out in the home loan business. Credit growth's improving after a weak period. That's great. So it means that the home loan books are going to be okay. Bad debts are down. That's great too. People say we're at the bottom of that cycle, but if you take my view on long-term interest rates, perhaps, bad loans are not going to be the big issue that they were when we had these big spikes in interest rates and delinquent payments, obviously, and arrears. So, look, I take the view that, we are at a really good point for bad and doubtful debts in terms of most of them rolling off the book and being dealt with really well, and a much lower provision being needed for those. But what I would say is I think that's probably an ongoing thing in Australia and the rest of the world, the Western world. So in terms of CBA, good result. Scorecard probably 7 out of 10. Looking forward to hearing the ANZ and NAB trading results next week, which I'll be tuned into. And Westpac, which I didn't mention, is very similar to CBA. So it's a domestic based bank. Our view is we're running at about 70 base, nearly 1% underweight. Be interesting to see how we go after we've listened to the results coming through. Target price Westpac's about $37 in our model, and we're at about 34. So really, I'd probably be thinking about bringing my Westpac weight up a bit, leaving my CBA just slightly at or around market weight, and keeping my overweight to NAB, and maybe looking at taking some significant profit in ANZ over the next few weeks.